How do you invest and make passive income? I feel that a lot of times when I ask that question, what I receive as an answer is what to invest in and not necessarily how.
Yeah.
So if I'm just starting out, this is a good video for you.
Absolutely. So what we're going to do is we're going to peel back the layers and try to make this as least intimidating as possible so that you have the tools that you need and understanding like what ways you can go about investing without understanding the investment in the first place.
Right, because the very first thing is make sure that you have the funds to do the investment. And
you might need that.
And one of the very first ways in which you can invest is through leverage. And remember, I said leverage, not debt. There's a difference between the two that I think a lot of times we get confused. Debt is when you purchase something that you can't afford. Leverage is when you purchase something that you make more money from than what it costs you to get access to those funds.
Yeah. And well, let's talk about that in the sense of a lot of times you'll find investors when they're buying anything or investing in anything, they go into debt, meaning they are borrowing money from someone else. But exactly to your point, Darius, is they're not doing something that consumers typically do where they go into debt to buy something that they basically can't afford or don't necessarily need.
Right. And in both
irresponsibly spending.
Irresponsible. And I think that's what it is, because in both instances, what you do is you leverage your future earning potential for getting access to something right now.
And what does that mean, though?
Meaning you don't necessarily have the funds or don't want to put the funds that you have up. You're going to anticipate that in the future that you're going to have more money than what it costs you to take care of it, or use your future earning potential to pay for what you're getting right now.
And that's what consumers tend to do is they use their future earning potential as the leverage to buy things. Meaning, let's talk about a mortgage, for example. When you fill out your mortgage application, they want to know how much can you afford, how much do you make, right? So you're putting your salary, your future earning potentials up for leverage in exchange for this house. So that's not what we're talking about. What we're talking about is leveraging debt in the sense of borrowing money at a low interest rate, but you know that the investment that you're doing, you're getting a higher interest rate than what it costs you to have the money out. So that's what we're talking about, leverage. And typically when you speak to any investor, they're always going to use leverage, someone else's money, OPM, other people's money, to invest. That's our favorite way to invest, is using OPM, because we don't have to use our capital to invest. It keeps us liquid.
Right. And this is exactly what we did when we first started investing in real estate. Is we use private money lenders in order to invest in real estate deals. And the way we help mitigate our risk is we invested in multiple deals. Like we would borrow money at 10% for an entire year, and we would invest that money into multiple deals, so that by the time the year was up, not only have we used the money multiple times and put it across different deals, but we also have a surplus of cash where we can keep that money and roll it into another opportunity where we don't have to borrow as much money moving forward.
Yeah, and I think you had said a few words that I want to explain. So you're talking about private money lenders. What does that mean? So if you're just getting into investing and you're trying to figure out what is a private money lender, because all we knew at the time was going to the bank, that's where the money is. Private money lenders are privately held individuals, people who you know who have money. That could be your mother, your father, your neighbor, whomever it is, people who have funds. And typically when you know people who have money, they're just sitting on it. They're not really doing anything. So what we started to do was to negotiate with friends and family to say, hey, we know you have money in your 401k, or we know you have money just sitting in the bank. It's not doing anything for you. If we can give you 10%, do you want to work out a deal? And 9 times out of 10, people want to make money. So it works out. So when you hear the name private money lender, it doesn't have to be something that's intimidating. It can be just someone that you know, and or it can be a business. Businesses can do this too.
Right. And one of the pros to that is the fact that when you go to a bank, when a bank loans you money for an investment or an opportunity, real estate opportunity, for example, they're only going to loan you a certain percentage of that deal. They may give you 80% and you still have to come up with 20%. When you use private money, there isn't necessarily a limit or a percentage of the deal that they'll give you. You can get up to 100% without any issues. One of the cons to it is if the deal goes bad, whether you borrow from a bank or from a private money lender, the deal goes bad, you then have to replace those funds with your own personal cash.
Yeah. Yeah. So the first way exactly that we're talking about is using leverage. So using OPM. And again, the importance of, or the pros and cons, I would say, and you kind of talked about one of the cons, is you have to pay the money back. God forbid there was ever an issue. Granted, you have to pay the money back regardless, but you always want to make sure that you understand the investments that you're getting into so that you don't run into the issue of not having the funds available to pay back your lenders. Because the obvious thing to do is to have solid deals, because if you keep returning the funds, your lenders are going to want to keep playing the game with you. So you always have to cover your bases, cover your assets in many different ways, and make sure that you're investing in something that's going to give you an actual return.
Right.
So leverage is the very first way that we can say that you can invest. You can borrow from another entity at a lower interest rate and make more money, and you basically split the difference.
Basically debt.
Yeah. So you are technically going into debt because you do have to pay back the money. But the point again is leverage, and the significance, the pro in this is that you're not using your own money. You can continue to stay liquid, and you can use someone else's money to continue to flip deals.
And the con is the fact that you're using somebody else's money. So if the deal goes bad, you'll be out of somebody else's money and still have to come up with the money in the first place to pay them back, or you get sued.
Yeah.
Now,
well, one thing before you jump into the next point is, I think as investors, when you're just getting started,
you don't necessarily have the funds.
You don't have
That's
the funds.
exactly why we did it in the first place, is because we didn't have the funds to fund 100% of the deal. So we had to get help.
Yeah, with any investment that came our way. And the other thing too is I feel like for us, we were lucky enough to be surrounded with people who were already investing. So we kind of understood that you could use the power of leverage. But those of you who may not know that you can do this, the only other obvious way that you can fund deals is to go to the bank and get a loan. And you have to fill out all the paperwork and go through all the rigmarole about, what it is that you're trying to do just to maybe get approved.
Right. And if you're doing real estate, what that's called is a hard money loan.
Yeah. So the main thing that you want to ensure is that you understand your options on what you can do and how you can invest, because we never want people to feel discouraged and think that, oh man, I have to wait until I have $50,000 in the bank to get in the game. And that's not the case at all.
Yeah.
Never the case.
And that's the fortunate and unfortunate thing about living in the U.S. is the fact that you always have access to money. You have access to debt, because that's basically what our economy is built off of, is debt and interest. So keep that in mind. If you're new to investing and you don't necessarily have the funds, there's always an opportunity for you to get in debt. It's easy to get into, but it's a little difficult to get out of.
Yeah.
But as we transition...
I'm sorry.
Okay.
One more thing. You said hard money loan. So again, we're trying to make this as least intimidating as possible. So sometimes we're used to these words, but I want to make sure that we define them. So Darius mentioned a hard money loan, where he was relating that to going to the bank. If you hear about a hard money loan, typically this is working with a third-party financial institution who is not the bank. When we say bank, we're saying like there's not Wells Fargo or Bank of America outside their door. They do finance deals, but the difference between them and the bank is their interest rates are going to be significantly higher because they know they're not the bank. So they're like, if you're not going to go to the bank, you can come to us, but we're going to charge you more interest and probably some points, meaning some extra percentages on the front end, meaning when you get the money, and then on the back end once you get your profit. So you need to understand, again, the options that you have. Many of us have used hard money loans because that was available to us at the time, and they can be very valuable. So I don't want to cast a shadow that they're not. Again, it's just understanding the options that you have. So for us, what we would say is, if you're just getting started, absolutely start the private lender way. If you want to go into leverage, and just find people who have money that they're not doing anything with, and then make sure you educate yourself as much as you can and that investor, so that they understand what you all are getting into. And then the next option would be a hard money loan. And then for us, I would say the last option would be the bank.
Yeah, absolutely. Now, as we transition in our investment journey or the opportunities that was presented to us, we started building up cash. We started having free cash flow that we can put into these deals ourselves, meaning that we didn't have to rely on paying somebody else interest in order to have access to their money. We're able to keep all the interest to ourselves.
Yeah.
And that's the very next thing is what our private money lenders were doing is the fact they were storing up cash inside of their savings accounts or inside of their retirement, and it was just sitting there.
Yeah.
They gave us access to that money so that we can use it. We wanted to be those people that had access to cash. Why? Because cash is king. And what we started doing is we started saving up our money, and then we started using less and less of the private money lenders because it was too many people in the deal. And if you want to make more money from a deal, you cut out people inside the deal.
And that's juicy. So how do we even go about trimming the fat off of that? It's important to know that when you invest, a lot of times there can be many people in bed with you with that investment.
A lot of times there are.
There can be 4, 5, 6, 100 people involved in one deal, depending what it is that you're doing. So for us, what we were always trying to strive to do was to own more and more of the deal so that we weren't splitting it with hundreds of people, if that makes sense. So that's why Darius was saying for us, it was all about trying to figure out other ways where we weren't necessarily using multiple private money lenders. We were working with some other cash that we had accumulated from other places so that we could own more of the deal.
Right. Now,
and keep more of the profit for ourselves.
Right. And what that helped us with is risk. We didn't have anybody calling us on the status of a deal or any disgruntled investors saying, hey, I need my money back early because something came up. You don't have to worry about any of that stuff when you have the cash. When you have the cash, you have control. And control is very, very, very important to not only to the deal, but also your mental well-being as it relates to the investment. Because if something comes up with the investment and you have somebody else's money attached to it, even if you have the bank's money attached to it, you start worrying about whether or not you're going to be able to not only get this deal to make the payday, but it's also brain power that you waste where you're not thinking about another opportunity.
Yeah, and continuing to flip the money. Now, something that you brought up, which I thought was really interesting about private money lenders and how things come up. You know, we have had instances where we invested in a deal with a private money lender, and then, you know, a few months later, they're like, hey, I need my money back. Like, what do you do when you have the money invested in the project, and mid-project, you can't just stop everything. So we also don't want to paint the picture that, oh, it's just amazing. Go ask all your friends and family for money and make it happen. You also have to make sure that you do your due diligence and create the relationship where these people know you're holding this money for X amount of time, and they understand that they just can't come 2 months later down the road and go, you actually know, I really don't want to do this anymore.
Right. And we mentioned the pros. The pros is the fact that you don't have to worry about anybody else in this deal, and you get to keep all the profits minus the capital gains that you have to pay. But the con to it is the fact that money is sitting until a deal presents itself.
Of having your own capital.
Of using your own capital. Now, we know that one of the rules of money is that money has to stay in motion. And at no time that our money's sitting there is it just sitting there. Remember? If you go back to any of our old videos, we know that when we have our money sitting in the banks are constantly using it to create debt for other people so they can pay them back principal and interest.
Oh, yeah.
And what we're doing is contributing to that cycle by having our money just sit there. That's why I call this a con for this particular thing, because it's working for them, but not necessarily working for us.
Yeah. And really what you have to determine when you're investing is the lane that you want to drive down. Really, that's what it is. So again, we're not talking about what it is that you're investing in. We're talking about how you can invest. And the two ways that we've discussed this at this point is leverage using OPM, other people's money, and or second part is using your own own money. And a great thing that Darius was talking about is if you use your own money, the money's going to sit there until the next deal. And the next deal could be 6 months from now, it could be tomorrow, or it could be 2 years from now. You just don't know. And that you're always going to be kind of in a bind because you want to always be earning money. And it's hard to use your own money in some instances if you don't constantly have a book of deals coming, your way consistently.
Right.
So those are just different things that you have to think about. And then the other con, I would say, is when you use your own money, now your capital is tied up. So when you need cash, when you need liquid, whatever it is, what are you going to do? Because now you've used your own money.
So basically there's benefits to both leverage and using your own capital.
Totally.
But that's just how our journey has transitioned over time. We went from borrowing money to having free cash flow to where we can use our own cash in deals. So the question I have for you is, how has your investment strategies changed over time? Comment
below, let us know.
Yeah, comment below. Has your investments changed over time?
And we also know that these two ways that we're talking about, again, we're just simplifying it. There are so many creative ways that people get involved with investing. And we just wanted to create a simplistic video in this instance. So if you have some amazing creative nuggets that you want to share, definitely comment in the link below. We'd love to learn.
And also make sure you check out the description below and see how you can become part of the Wealth Nation and continue the conversation about investing and real estate.
Now, the third point that I love the most, and I know that you're the most jazzed about, is being able to do a combination of both. Leverage and using your own capital. Who knew that you could do that?
Yeah, how can you do that? How can you leverage somebody else's money and still have access to liquid cash?
Well, Darius, let me tell you, my friend. For those of you who are new to the Wealth Nation channel, welcome. But Darius and I, we talk about the beauty of using life insurance, go figure, and whole life insurance at that. So whatever you've heard or haven't heard about whole life insurance, just stick with us for a minute, because there's some really amazing things that you can do that isn't, I would say, mainstream in the sense of like, people just aren't teaching this off the side of the road.
Right. So whole life insurance is the foundation of how we invest now. Reason being is, regardless if we use the money or not, we're still going to continue to earn interest. So it checks one box, which means that our money continues to earn interest.
And I think, again, you just said a huge nugget that we need to preface. It is the only asset that we know of, and we've studied a ton of different asset classes, that, as Darius just said, the money still grows regardless if we use it or not. The money still grows regardless if we use it or not. And so for us, we just found this to be a humongous asset that we needed to put into our own toolboxes and to fund it so that we can leverage the insurance company, and that so we can also put our own money into these policies so that it can continue to earn. So when we talk about leverage, if you have a whole life insurance policy, whenever you fund a whole life insurance policy, you're going to get one of two things.
Well, a properly designed policy. Let's start with that.
The terms that you may have heard is overfunding a whole life insurance policy, meaning you're actually adding money so that you can have cash, liquid cash available inside your account. So that's why I was saying there's two things that will happen. You'll get a death benefit, meaning if something were to happen to you, then money will pass to your family. And then there's also something that grows inside of the policy called cash value, which is the liquid cash you can utilize. And when we utilize the cash value, the cash that is available to us as policyholders, we get a loan from our life insurance company. And what this loan does is it allows our funds to continue earning a guaranteed rate of return, but the money that we're getting is actually from the insurance company. So we're leveraging the insurance company's money, kind of going into debt with the insurance company, and leveraging our life insurance policy. So if there is the need for a payback, they can take the money from our death benefit.
Right. Now, two things that I want to address is the fact that when you're able to continue to earn interest, regardless if you have money borrowed or not, that allows you to then use the money to earn additional interest, which means you're able to grow money in two different places. I don't know too many vehicles in which you can do that, where you can earn money in two different places.
Yeah.
The second thing is the fact that when you do borrow money, there is a cost associated with it. The reason why I'm okay with the cost is because if I take a look at a 4% interest rate, regardless of what insurance company you use, the numbers may be different. But for me in particular, me specifically for our situation, we can borrow the money at 4% interest. When we were borrowing OPM, we were paying 10% interest. So I'm good with the 6% difference.
Yeah.
I'm okay with that.
Fine. Totally.
Yeah, I'm able to reduce it more than double.
Yeah.
So the nice thing about that is the fact that you don't have anybody calling you, because the loan that you have is a loan that you don't have to pay back ever.
Yeah.
You don't have to.
But let's preface that, because so many people are going to take that and go, "What Darius said." So what we're trying to communicate is you have the flexibility to pay back the loan at any point during your lifetime. We're not saying don't pay it back, because when you pay back the loan, that's more money that's available to you.
Right.
What we want you to know is that if you didn't pay back a loan and you happen to pass, like I was saying before, the insurance company is going to deduct any outstanding loan that you have from your death benefit, and that's how they get paid.
Right. And the point that I was trying to make is it doesn't matter what the deal frequency is, as long as you earn more than what it costs you to borrow money in the first place, which is how we started practicing in the first place when it comes to leveraging debt. Yeah. This is just a different form of leverage, where you're leveraging your life insurance policy. And the idea that you want to take, or the important thing you want to take from this, is to borrow money at a lower interest rate in which you pay.
Totally. That's how you should always do it. That's the only way that the power of leverage works.
You're right.
And don't run into the issue where it's costing you more money than what you're earning. That's a no-no.
Right. Now, what this gives you is access. It gives you access to cash. And what we all want, or what we all need, or how we can continue to increase our net worth, is we increase it by the level of access that we have.
Yeah.
And this whole life insurance policy gives us access. Now
access, liquidity, same thing.
Exactly. Now, we talked about the pros, but some of the cons of this is the fact that you can mismanage it. You can mismanage it. A lot of people, when we talk about debt, people go into debt to buy stuff that they can't afford. Same thing applies when it comes to how you use your life insurance policy. You can use your life insurance policy to get rid of bad debt, but the important thing for you to do is to repay those debts back to yourself. Yeah. The purpose of this video is talking about using your life insurance policy to invest. This is how you increase your net worth, by investing, not taking on bad debt. So there's a difference. That's how you can really put yourself in a bad situation, by using it for a bad situation.
Yeah. And like you said, not paying the loans back, and now the interest of the 4% or the 5%, whomever your whatever carrier you're working with, starts to accumulate and add up, and now the system is broken. And that's why a lot of times people, if they hear about this strategy and then they fund a premium, and then next thing they know, they get a loan and they don't pay it back, and then they go, "Oh, this thing didn't work." Well, it's because you didn't follow the rules.
Right.
And the rule is the power of leverage. Whenever you get a loan, you should always be making more money than what it costs you, so that you can pay it back. The money becomes available again as far as liquidity, and you can continue to do this over and over again while your money is still earning inside of the whole life insurance policy.
Right. There's a basic rule of money that I think sometimes we forget, or we've never learned, is the fact that money has to stay in motion. And by us repaying the loans back to our lenders, or paying the money back to our life insurance policy, what that does is that continues the natural motion of money, meaning that we need to pay it back principal and interest. Even if we save money, we need to pay ourselves back with interest, because if we don't pay ourselves back with interest, we're not even keeping up with inflation. We're not keeping up with a lot of different variables that come into place that happen to us that we don't necessarily see, like taxes, for example.
Yeah. And as you were just saying, money needs to stay in motion. I was just thinking about, I just like had this visual come over me. So I was thinking about, we always talk about, money needs to stay in motion. And I was just thinking about, money needs to stay in motion toward you, where you're paying the money back. You're being true to yourself in the system and the principles that you created. So now you have the motion of money staying in your own economy. Where we get into trouble and the debt is when the money is in motion away from you. right? So every time you spend something, the money is going away from you. The money is leaving your account. That's not what we're talking about. That's the wrong motion that we want you to go in. The motion that we want you to go in is the motion towards yourself, where you're repaying, where anytime that you're doing some sort of investment, it's coming back to you. It's coming back to your system with friends, aka interest, so you can continue to do it over and over again.
This happens because naturally we've been taught to be consumers. There isn't anything that we really produce that we can create an opportunity for money to come to us. Everything that we do is for money to go away. So, I mean, for example, that's why when the feds gave us those checks, that's why the wealth gap got bigger. Everybody got a check, but the wealth gap got bigger because the people that consume, what they had to do is they had to pay rent, they had to pay for necessities, they had to pay their bills back. People that understand how to create wealth, what they did is they used those funds to make more money. That
they kept it in the right direction as opposed to going away. And these are the things that we feel are crucial for you to understand and learn as you're going throughout your money journey, as you're really starting to consume when it comes to financial literacy and all of that is concerned with, is protecting yourself. We're always talking about paying yourself first. This all boils down really to paying yourself first, because what we're taught with money, like you just said, is to spend money and not keep it. So we always say it's not about how much you make, it's about how much money you keep. And it can be really powerful when you learn these principles and then start to level up in understanding, okay, when I invest, am I going to leverage, or am I going to use my own cash, or am I going to do both and use maybe my whole life insurance policy, for example? You always have options, but the thing is, a lot of people, or a lot of times, we just don't know that there's options.
Right, and I think that's one of the reasons also why a lot of small businesses don't stay in businesses, because of how they leverage money. When you go and you use third-party funds, you're at the mercy of what they decide to do.
And what we saw with COVID, how many small businesses shut down because
they didn't have control of their capital.
They didn't have control. They weren't liquid, whatever the case may be. That just really goes to show that in any economic downfall that we have, you always have to be liquid, which is why when we talk about the power of leverage and using OPM is our favorite way to invest, is because it keeps us liquid.
Right. We need to be running our personal lives the same way we would run a business, because it is a business. The laws of money doesn't change for you personally versus you for a business. The only difference is you have more tax write-offs that you can use for a business.
That's a good point.
Right.
Yeah, I would say so.
If you want more information on how you can leverage whole life insurance policies for your next investment, make sure you check out our masterclass, where we go into a little more detail about how you can use this in your own personal life.
And don't forget to own your own lifestyle,
or someone else will.